Imagine yourself back in 2021. The world felt uncertain, but one thing was undeniably true: the value of your home was a golden ticket. Money was essentially free, the stock market was soaring, and every news anchor was telling you that real estate was the only safe harbor left. You were making a move, maybe escaping a city for the sunshine of the Sunbelt, or maybe upgrading in your expensive coastal town, convinced that even though the price tag made your head spin, it was a sound, generational investment. You saw a house in Austin, Texas, or Boise, Idaho, and you paid $50,000 over the asking price without even blinking. You waived inspection. You felt a rush, the exhilarating, terrifying high of securing a scarce resource. That feeling, that confidence, was the purest expression of the greatest financial mirage of the modern era. Today, we stand in the cold light of reality, and what you are seeing is not a slight correction, it is a violent, overdue reckoning. The question is no longer if the market is going to fall, but where the floor is going to drop out completely. This isn't about losing 5% or 10%, this is about a systemic unwinding in specific, high-stakes geographic areas, where the very foundation of the economy, the jobs, the insurance, the population growth, was built on a temporary fantasy of zero-rate money and limitless demand. We are going to name the 10 most vulnerable cities in America, where a confluence of factors guarantees a collapse that will erase an average of $500,000 in equity for the peak buyer by 2026. This is the $500,000 mistake. The analysis begins not with fear, but with facts, with the 4 pillars of financial vulnerability that mark a housing market for destruction. The first pillar is overvaluation. This isn't subjective. We measure this using the price-to-income ratio. Historically, a home in America should cost roughly 3 times the median household income in that area. During the pandemic boom, in some of our doomed cities, that ratio soared past 7, 8, and even 9. People were paying San Francisco prices with Midwest salaries. When the cost of borrowing money jumped from 3% to 7% in a single calendar year, the market didn't just slow down, it froze. Suddenly, the entire purchasing pool vanished, leaving sellers staring at a number, their mortgage balance, that no realistic buyer can afford to service. The gap between what a seller needs to cover their debt and what a buyer can afford to pay is the abyss into which millions of dollars of home equity are now falling. The second pillar is investor exit. The pandemic housing boom was not driven by families, it was driven by institutional capital. Hedge funds, private equity firms, and tens of thousands of individual flippers saw housing as the ultimate cash flow machine. They bought up single-family homes, often paying cash, turning them into rentals. In cities like Phoenix and Dallas, investor activity topped 30% of all transactions at the peak. These are not emotional buyers, they are pure financial predators, and they follow one metric: yield. As interest rates climbed and property insurance costs soared, our third pillar, that rental yield, evaporated. Now, these institutional landlords are facing negative cash flow and massive holding costs. Their strategy is simple: dump the asset before the bottom falls out. When an institutional investor decides to exit a market, they don't sell one house, they offload hundreds, creating a simultaneous spike in supply that no normal market can absorb. This intentional, calculated market saturation is the trigger for the true free fall. The third pillar is uninsurability and climate risk. You can withstand a mortgage crisis, but you cannot withstand a climate crisis. This is a new, catastrophic layer of risk that was barely a consideration in 2008. From the coastal erosion in Florida to the wildfire risk in the Mountain West, major, national insurance carriers are no longer pricing the risk, they are simply withdrawing from the market entirely. They are refusing to write new policies or renew old ones in designated high-risk zones. For cities like Cape Coral, Florida, and certain parts of Malibu, California, securing basic homeowners insurance is now a labyrinth of high-cost specialty carriers and limited state pools. When a home cannot be insured, it cannot be financed. This is a death sentence for liquidity. Even if you want to sell your property at a deep discount, you may not find a lender willing to underwrite the risk. The financial risk has become a literal, physical risk, baked into the very ground the house stands on. This risk is already eroding property values by tens of thousands of dollars, and it's only getting worse. The final pillar is economic singularity. The most vulnerable cities are those that put all their economic eggs in one basket: low-interest tech jobs, remote work migration, or a specific, localized industry. When the sector that created the boom begins to contract, which is happening now with widespread tech layoffs and hybrid work mandates, the entire local economy is suddenly exposed. The high-paid newcomers who inflated the housing market are the first to be laid off, and they are the first to sell because they have no community roots or compelling reason to stay. This is what we are seeing in places like Seattle, San Francisco, and Denver, but it's hitting the smaller, less diversified boomtowns even harder. The demand that justified the peak price vanishes overnight, leading to a sudden and violent re-rating of what the local economy can actually support. These four pillars, overvaluation, investor exit, uninsurability, and economic singularity, form the foundation of our analysis. Any city facing all four simultaneously is guaranteed to be one of the 10 cities we name today. We are not predicting a national collapse. We are identifying the pinpoint structural failures where the most concentrated wealth destruction will occur. By the end of this deep dive, you will understand the critical difference between a softening market and a financial black hole, and you will know exactly which markets to avoid, protect, or potentially short. The journey begins with our first set of doomed destinations, starting with the Sunbelt hubs where the investor money is drying up first. Stay with us as we head to number 10. We are beginning our descent into the most vulnerable markets in America, cities where the collective denial of overvaluation is about to trigger a historic financial correction. As we move from number 10 to number 4, the risk factors compound, moving from simple oversupply to deep, structural insolvency. Number 10. Las Vegas, Nevada. The allure of Las Vegas has always been built on illusion and endless expansion. For years, the story was simple. People are fleeing high-tax California and bringing their equity with them. But what happens when the equity-rich buyers dry up, and the people moving in are dependent on a single, extremely fragile tourism and convention industry? Las Vegas's market is defined by investor fluctuation. During the boom, investment firms saw a stable, high-yield rental market. Now, with mortgage rates and property taxes pushing up holding costs, those yields have evaporated. The signs of distress are appearing first in the sheer volume of new listings. The moment those institutional landlords decide to offload their assets, the inventory spike will become a wall of supply that buyers will not be able to climb. The average price in Vegas has to shed at least 35% just to return to a realistic price-to-income ratio that local wages can sustain. The $500,000 mistake here is believing the party on the Strip can finance your suburban home price forever. The music is stopping, and the lights are flickering out. Number 9. Portland, Oregon. Portland presents a classic case of exodus and expense. The city once attracted high-paid tech and creative workers willing to pay a premium for the lifestyle. But as municipal challenges and rising costs became impossible to ignore, a mass outflow began. Net migration data shows a steady, accelerated stream of long-time residents and recent arrivals cashing out and leaving the state entirely, typically moving to lower-cost Mountain West states. This is a crucial distinction. Unlike a normal downturn where sellers wait it out, these are motivated sellers who need to liquidate their assets to fund their next purchase elsewhere. This creates an unnatural, forced supply surge. Add to this the economic singularity risk from a tech sector that is consolidating and cutting jobs, and you have a market where demand is shrinking while supply is being forcefully injected. The market correction here will be harsh because the emotional attachment is gone, replaced by calculated flight. Number 8. Dallas-Fort Worth, Texas. Dallas is the poster child for oversupply disaster. The Dallas Metroplex has seen a massive influx of corporate headquarters and population, but it also saw a relentless, unprecedented surge in new home construction. The developers, drunk on cheap capital, built too many houses, too many condos, and too many master-plan communities, often on the outskirts where infrastructure is strained. Now, they are caught in a classic trap. They need to sell these homes to service the massive construction loans. This desperation leads to heavy incentives, massive price cuts, and free upgrades, actions that aggressively devalue the existing housing stock around them. The investor exit is also massive here. Funds that bought thousands of single-family rentals are facing negative cash flow and are poised to dump inventory. When the sheer volume of supply overwhelms demand, the price fall becomes a certainty, and the dollar amount lost in a high-priced metro like Dallas easily reaches that $500,000 threshold for anyone who bought near the $600,000 to $800,000 range. The Texas dream of endless growth is crashing headfirst into the reality of finite demand. Number 7. Denver, Colorado. Denver, much like its regional rival Salt Lake City, is suffering from tech debt overvaluation. The mile-high city's housing boom was disproportionately funded by high-debt, high-income tech workers who used stock options and deferred compensation to justify massive mortgages. This created a luxury bubble that had no grounding in the historical Denver economy. We are already seeing luxury home sales slow to a crawl, with listings sitting for 6 months or more. The risk here is contagion. As the upper-end sellers, who need to liquidate their assets following job losses or failed startups, are forced to drop their prices by 30% or more to find a buyer, the collapse begins to contaminate the middle and lower tiers of the market. Furthermore, Colorado is wrestling with significant uninsurability risk due to accelerating wildfire danger. Insurance costs in mountain-adjacent suburbs are already prohibitive, adding a second layer of systemic stress. Denver's market is hollowed out, ready to crumble the moment its high-paid workforce sheds its inflated equity. Number 6. San Jose, California. While often protected by the sheer wealth of Silicon Valley, San Jose is facing a triple threat: hybrid work decay, high local taxation, and economic singularity. This is not a classic bubble, it's a collapse of the value proposition. The extreme prices in San Jose were justifiable only under two conditions: high wage, in-person work, and a sense of municipal stability. Both conditions are faltering. As tech companies settle into a permanent hybrid model, the need to live 10 minutes from the corporate campus evaporates. This allows residents to move inland or to other states entirely, funding the next state's housing boom with their massive Bay Area equity. Furthermore, local tax policies targeting high-value properties have created a punitive environment for sellers, leading to a liquidity freeze. San Jose's extreme median price means even a 25% price reduction translates to hundreds of thousands of dollars in lost equity, quickly hitting our $500,000 threshold for homes bought at or above the $2 million mark. The high-stakes nature of this market ensures that when the fall comes, it will be the most dramatic dollar value destruction in the country. Number 5. Cape Coral, Florida. Cape Coral is the canary in the coal mine for the insurance apocalypse. This is a terrifying example of the climate risk component overwhelming all other factors. Forget interest rates and job losses, the primary driver of the crash here is uninsurability. Florida's private insurance market is in total retreat due to hurricanes and flooding. Homeowners are seeing annual premiums jump from $3,000 to $15,000 in a single year. When an asset's carrying costs become this high, the market is instantly destroyed. A buyer can easily walk away from a deal if they can't secure a reasonable policy, or if the policy requires a massive deductible. Even cash buyers are now factoring in decades of sky-high insurance costs when calculating their offer, instantly devaluing a property by tens of thousands, if not hundreds of thousands, of dollars. The city's geographic risk is literally pricing it out of the residential real estate market. The price correction will be permanent, not cyclical, reflecting the new, existential cost of living on the coast. This is a brutal lesson in financial risk meeting environmental reality. We have moved through 5 deeply vulnerable markets, each with a unique flaw: investor dependence, mass exodus, oversupply, tech debt, and insurance apocalypse. The next 4 markets on our list present even more complex and deadly combinations of these factors, representing the absolute pinnacle of risk in the American housing market today. We are accelerating toward the bottom of the list, where the ultimate financial mistakes were made during the boom. We now move into the core of the danger zone, the markets where the combination of unsustainable debt, climate risk, and mass exodus creates conditions for a total, systemic collapse. These are the cities that exemplify the absolute peak of the housing bubble, and where the most painful deleveraging will occur, guaranteeing that $500,000 mistake. Number 4. Salt Lake City, Utah. Salt Lake City's boom was driven almost entirely by the tech sector and a religious devotion to home ownership, creating a unique strain of affordability shock and debt exposure. The influx of high-wage workers from the West Coast pushed home prices up by over 70% in 2 years, far outpacing local median incomes. This created a generation of buyers who stretched themselves to the absolute financial limit, often relying on high-leverage loans and massive amounts of non-mortgage debt to make up the difference. When the inevitable slowdown arrived, the market had zero elasticity to absorb the shock. Listings are now piling up, and the days on market are stretching into months, yet sellers remain stubbornly anchored to 2022 prices. This standoff is lethal. The moment the first wave of financially stressed homeowners is forced into foreclosure, driven by layoffs or high-interest credit card debt, the entire facade will crumble. This isn't a simple correction. It is the forced unwinding of personal balance sheets that were an unprecedented, irrational price spike. But the reality of remote work is setting in, companies are recalling workers, and the novelty of a life far from core amenities is wearing off. Boyce's economy lacks the diversification to support current prices without that steady stream of high-wage transplants. The most damning indicator here is investor retreat. The same out-of-state institutional investors who bought thousands of houses in Boise are now seeing the lowest rental yields in the entire country, forcing them to liquidate their assets at a loss. When these professional money managers decide the risk is too high, the retail buyer should run for cover. The prices here must correct by a minimum of 45% just to be justifiable by local, pre-pandemic income levels. The $500,000 mistake here was not buying a house, it was believing the boom was permanent. The crash will be severe because the fundamental demand that created the bubble was entirely synthetic and temporary. Permanently reset the market's price floor. This is a supply shock unlike anything seen in 2008. In the last crash, the supply was driven by distressed individual foreclosures. This time, it's driven by calculated, profit-driven institutional retreat. This mass dumping drives the typical home price down another 15% to 25%. This is where the price charts officially enter bear market territory, and the average buyer who purchased near the peak is now officially underwater. Their home is worth less than the debt they owe. The third stage, the negative feedback loop. This is the final stage of total collapse, currently being priced into high-risk coastal areas like Miami and Cape Coral. It's when the market becomes unfinanceable. Due to accelerating climate risk, state-supported insurance pools run dry, and the few remaining private carriers hike their annual premiums into the five-figure range. The high insurance costs, our pillar of uninsurability, kill the cash flow, which in turn causes the appraiser to lower the home's valuation because the cost of ownership is too high. Lenders pull back. They require higher down payments, reduce the loan-to-value ratio, or refuse to lend at all in specific zip codes. This action starves the market of buyers and creates a vicious, self-fulfilling prophecy. No buyers means prices fall. Falling prices mean lenders demand even more collateral or down payment, which further reduces the buyer pool. The only people left are cash buyers, who demand massive discounts, upwards of 40% to 50%, to compensate for the insurance and climate risk they are inheriting. This loop is what locks in the $500,000 loss for the peak buyer. A home bought for $800,000 in 2021 is now being appraised at $450,000, and the only offers coming in are $400,000 cash. That is the $500,000 mistake realized. The escape plan, your financial countermeasure. This situation demands immediate, decisive action. For those caught in these top 10 zones, there is a clear imperative. You must prioritize liquidity and risk mitigation over stubborn price anchoring. 1. Aggressive risk assessment. If you are in one of the cities we named, the time for denial is over. Pull a fresh comparative market analysis, CMA, based only on the last 6 months of sales, ignoring the 2021 to 2022 peaks. Look specifically at properties that required multiple price cuts or sat for over 90 days. Calculate your true, post-sale loss now, rather than waiting for it to be forced upon you later. Understand the true cost of your property. Add your yearly property tax, maintenance, and the new, higher insurance premium. If that total carrying cost exceeds 1.5% of your home's current value, you are in a financially precarious position. 2. Reduce carrying costs. If you must stay, explore every option to reduce the drag. Aggressively fight your property tax assessment, as valuations are almost certainly based on outdated peak numbers. Shop your insurance policy relentlessly, or if you can, pay down your mortgage principal to reduce your monthly interest outflow, which acts as a hedge against future valuation declines. 3. The exit strategy. For those who bought after 2020 in the most egregious markets, Austin, Boise, Miami, your best financial defense may be an aggressive offense. Sell now before the next wave of institutional and forced selling hits. A controlled exit today at a 20% loss is infinitely better than a forced exit in 2026 at a 50% loss. Accept the loss, capture the remaining equity, and park those funds in a high-yield account or invest in a fundamentally sound, non-bubble market. The secondary cities and states that did not see this extreme level of overvaluation. The greatest financial defense is the ability to walk away from a bad asset on your own terms. The markets we named are not just facing a cyclical slump, they are undergoing a structural deconstruction that will redefine wealth and poverty for the next generation. The financial mistake has been made, but the ultimate destruction is not yet complete. The difference between those who lose $500,000 and those who manage to salvage their future lies entirely in the speed and finality of their action today. Do not wait for the headlines to confirm the crash, the data is already screaming the warning. Your financial security depends on listening.